It's the afternoon of January 20th, 2026, and your screen is lying to you. Right now, the COMEX ticker shows silver at $95 an ounce, gold brushing up against 4,700. The headlines are screaming historic rally, all-time highs, precious metals fever. And if you're watching Bloomberg or reading the Wall Street Journal, you'd think everything's working as intended, that the market functions, that prices reflect reality. What a beautiful illusion. But here's what they're not telling you. While your screen shows $95, Shanghai is paying $107. In Japan, dealers are reporting 2-hour lines in prices equivalent to $130 an ounce. 2-hour lines. For silver, in South Korea, the premium on the secondary market is over $103. In Sydney, Australia, people are lining up at 6 in the morning outside bullion shops. 2 markets, 2 prices, a gap of 15 to 30% depending on where you look. And nobody, absolutely nobody in mainstream financial media is talking about this. Curious, isn't it? I've spent 12 years analyzing the precious metals market, and I started this channel precisely to cut through the noise faster than traditional media can spin the narrative. I'm not here to sell you smoke and mirrors. I'm here because I saw something this morning that couldn't wait for some TV analyst to take 3 days to report while adjusting his tie. While everyone's watching the price on screen, I'm watching what's happening in the shadows. And what I saw is this. JP Morgan, the bank that paid $920 million in fines from manipulating this very market, just completed the most spectacular pivot in modern financial history. From 200 million ounces in short positions to 750 million ounces long. Read that again. The biggest manipulator of the silver market for 2 decades is now the biggest accumulator on the planet. The fox didn't just get into the henhouse, he moved in and took out a mortgage. Let me ask you something. If silver is just another overvalued precious metal about to correct, like the skeptics say, why is the most informed bank in the world hoarding it like they know a historic shortage is coming? Why are they willing to bet tens of billions of dollars in the exact opposite direction they defended for 20 years? I don't know about you, but when the casino starts betting against itself, I pay attention. Your screen tells one story. The shadow market tells a completely different one. And if you think the price you see on your app reflects the reality of what's happening with physical silver, buddy, you're about to get the shock of your life. This is Tomas Analysis. And if you're new to this channel, welcome to the club of those who've been warning about this for years. They called us crazy. They called us conspiracy theorists. They told us we didn't understand how sophisticated derivatives markets worked, that the banks had everything under control, that the pricing system was efficient and transparent. Well, turns out the crazy ones were right, and those who laughed at us are now watching the villain of the movie switch sides because he knows the game is over. How sweet it is to be right. Too bad it took so long. In this analysis, I'm going to show you exactly why the paper silver market is fracturing, what JP Morgan's pivot means, how China has turned off the global supply tap, why industrial demand makes it impossible for prices to fall, and what you should be watching if you don't want to be the last one to find out. Let's get into it. Let's talk about the fracture, because that's exactly what we're witnessing. A fracture between the paper world and the world of real metal. And no, that's not a pretty metaphor. It's literal. For 40 years, the price of silver has been dictated by the COMEX in New York and the LBMA in London, paper markets. Places where they trade contracts on silver, promises of silver, silver derivatives. Physical metal was almost secondary, a technical detail. What mattered was the contract, the future, the derivative. The real metal could wait. That system worked as long as nobody asked too many uncomfortable questions. It worked as long as industrial buyers accepted the screen price and didn't look too closely at whether the metal actually existed. It worked as long as investors settled for a number on an account instead of bars in a vault. But something changed, and that something is breaking the system. Silver lending rates in London are the canary in the coal mine. Normally, if a bank needs to borrow silver to cover a delivery, they pay less than 1% interest. It's a liquid market, there's plenty of metal, everything works fine. Last October, those rates spiked to 200%. 200%. If you don't understand what that means, let me translate. It means banks were so desperate to get physical silver that they were willing to pay double the value of the metal just for the loan. That doesn't happen in a normal market. That happens when there's no metal and everyone's trying to pretend otherwise. The Shanghai premium is another symptom of the same problem. When Asia's largest physical market consistently pays 13% more than the Western price, the message is clear. The price on your screen doesn't reflect reality. It reflects what Western banks want you to believe silver is worth while they quietly position themselves. China pays more because China wants real metal, not promises. And it turns out real metal costs more than promises. Who would have thought? But wait, it gets better. Retail dealers around the world are reporting something we haven't seen since 2011. Real shortages. Real lines. A user documented a few weeks ago what was happening in different countries. Japan, $130 equivalent per ounce with a 2-hour wait. Korea, $103 on the secondary market. Australia, lines since dawn. And meanwhile, your trading app tells you silver is at 95. There's a joke in there somewhere, but it's not very funny if you're on the wrong side. Now, here comes my favorite part. The story of the redeemed villain. Or rather, the villain who saw the ship sinking and decided to switch to the lifeboat before anyone else. Let's talk about JP Morgan. In September 2020, JP Morgan agreed to pay $920 million to settle criminal charges for precious metals market manipulation. Nearly $1 billion, the largest fine ever imposed for this type of conduct. And what they did was elegant in its simplicity and disgusting in its execution. It's called spoofing. You place a massive sell order you have no intention of executing. The market sees that order and thinks an avalanche of selling is coming. The price drops. You cancel the fake order. You buy cheap. Repeat thousands of times. Guaranteed profit as long as nobody catches you. They got caught. Michael Nowak, global head of the precious metals desk, 1 year and 1 day in prison. Greg Smith, executive director, 2 years. The bank paid. The executives went to the slammer. Case closed. Justice served. Everyone's happy. End of story. Except it's not. Because while everyone assumed JP Morgan had learned their lesson and would continue with their usual shenanigans but more carefully, the bank was doing something completely different. Throughout 2025, according to multiple analyses of COMEX reports, JP Morgan completely closed out their short position in silver. 200 million ounces in short contracts. Poof. Gone. And not only that, they started accumulating physical silver at a pace never seen before. Current estimates put their long position at 750 million ounces. To give you some perspective, that's approximately 40% of the entire COMEX futures market. Let me translate what this means in simple terms. The bank that spent 20 years making money betting silver would go down, that actively manipulated the market to make sure it went down, that paid nearly $1 billion in fines when they got caught doing it, that bank is now betting everything on silver going up. $40 billion in physical metal, not contracts, not derivatives, metal you can touch. The question isn't whether JP Morgan knows something we don't. The question is how long they've known it and how many times they told us the opposite while positioning themselves. But hey, I'm sure it's just coincidence. I'm sure it has nothing to do with everything else that's happening. Sure, if this content is opening your eyes, if you're starting to connect the dots, hit like. It's free, it helps me keep bringing this analysis, and it tells the algorithm this matters more than the latest cat video. Let's talk about China, because without understanding what's happening in Beijing, this story makes no sense. On January 1st, 2026, exactly 20 days ago, the Chinese government implemented new restrictions on refined silver exports. And when I say restrictions, I don't mean some minor bureaucratic adjustment. I mean turning off the tap. Under the new rules, only companies that meet two very specific conditions can export silver. First, have an annual production capacity of at least 80 tons. Second, obtain a special license from the government. The result is that out of hundreds of exporters that operated before, only 44 companies in all of China received authorization. 44. These companies control approximately 121 million ounces of annual exports. That's between 60 and 70% of all refined silver traded globally. China just put their hand on the global supply tap and closed it as much as they pleased. Now, the beautiful thing about this is how they did it. They didn't ban exports. That would be too obvious, too confrontational, too easy to criticize at the WTO. Instead, they created a licensing system that gives them total control. They can open or close according to their interests. It's brilliant in its bureaucratic evil. And meanwhile, Chinese domestic demand for silver, for solar panels, electric vehicles, and electronics keeps growing like there's no tomorrow. The numbers are telling. China exported more than 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They're massive net exporters. But now they're closing that export tap while their domestic buyers pay any price to secure supply. The Shanghai premium isn't a coincidence. It's the direct result of this policy. Chinese buyers pay 13% more because they know the metal is there, available, deliverable. Meanwhile, London and New York increasingly operate on promises. On paper, on hope. Good luck with that. Okay, but why does silver matter so much? Why can't they just use another metal? Why all the drama? Let me explain why industrial demand makes this problem impossible to solve easily. Silver is no longer primarily a precious metal. It's a critical industrial metal. Industrial demand represents 59% of total consumption. A decade ago, it was 50%. That 9-point increase might seem small, but in a market that was already in deficit, it's the difference between tension and collapse. The solar sector is the perfect example of the problem. Every photovoltaic panel needs approximately 20 grams of silver for its conductive contacts. There's no viable substitute that works as well. They've tried. Copper doesn't conduct as efficiently. Aluminum degrades. Silver is irreplaceable if you want the efficiency modern panels require. And here's the data point that should worry any panel manufacturer. In 2023, silver represented 3.4% of a panel's total cost. Today, with silver at $95, it represents 29%. 29% of your solar panel's cost is silver. That's a big problem. Every additional price increase translates to more expensive panels or bankrupt manufacturers. There's no option C. Electric vehicles use between 25 and 50 grams of silver per unit. Traditional combustion cars use between 15 and 28. Every electric car needs more silver than its gasoline equivalent. And the transition to electric vehicles isn't slowing down. It's accelerating. Then there are data centers for artificial intelligence. Every server, every chip, every connection. Silver. The International Energy Agency estimates that by 2030, just the solar and electric vehicle sectors will consume half of all global silver production. Half, for two sectors. That leaves jewelry, electronics, medicine, industrial photography, investment, everything else, fighting over the other half. The math doesn't add up, and it's not going to add up unless the price rises enough to destroy demand. And destroying demand means solar panels that don't get built, electric cars that don't get manufactured, data centers that don't expand. It means slowing down the energy transition. It means telling the world, sorry, there's not enough silver for the future we planned. Good luck selling that politically. Now, let's get to the numbers that should keep you up at night. Inventories. Because you can talk about demand all day, but in the end, what matters is how much metal there is to satisfy it. And the numbers are, how should I put this gently, terrifying. The COMEX, the main metals futures exchange in the United States, reports a total inventory of approximately 445 million ounces. Sounds good. Sounds like there's plenty of silver. But here's the trick that financial media never explains to you because they probably don't understand it themselves. That inventory is divided into two categories, registered silver and eligible silver. Registered is what's available for delivery against futures contracts. It's the metal you can claim if you have a contract and you say, hey, I want my actual silver. Eligible is metal that's in the warehouses, meets the standards, but isn't available because its owners haven't put it on the market. They're using the warehouse as a private vault, not as public inventory. Of those 445 million, only 124 million are registered, less than 30%. That's all that's available for delivery in the world's main futures market, 124 million ounces. Now look at open contracts. The March contract alone represents more than 500 million ounces of silver. 500 million against 124 million in real metal. 4 ounces of promises for every ounce of metal. For a single month of contracts, the system works because almost nobody requests delivery. Most roll their contracts, close them for cash, speculate with no intention of ever touching metal. But what happens when that changes? What happens when industrial buyers say, I need the metal for my factory, A PDF won't cut it. What happens when investors say, I want bars, not promises? The system doesn't have enough metal. Everyone knows it. Nobody wants to be the first to say it out loud. In London, the situation is just as fun. LBMA inventories have fallen approximately 40% from their highs. Daniel Galley from TD Securities estimated a few months ago that there's probably less than 4 months left before London's free inventory runs out at the current pace. 4 months. That puts us at May as the theoretical deadline. I'm not saying the system collapses in May. I'm saying the math points to something having to give before then. Either prices rise much more to incentivize sales, or someone publicly acknowledges that promises exceed metal. Neither option is pretty. If you see what's happening too, if you understand this isn't a speculative rally but the paper system breaking, subscribe and hit the bell. We're a community that's been preparing for this moment for years, and this is just the beginning. Let's talk about the accumulated deficit, because it's important to understand the scale of what we're seeing. This isn't a this-year problem, it's a 5-year problem that's finally exploding. The silver market has been in structural deficit for 5 consecutive years. 5 years straight, where demand exceeds supply. The accumulated deficit since 2021 exceeds 820 million ounces. 820 million. That's more than 10 months of global mining production. Poof. Vanished from inventories. And here's something a lot of people don't understand about silver. Unlike gold, which is mined primarily for the gold itself, 70% of the world's silver is produced as a byproduct of copper, zinc, and lead mines. That means even if the price of silver doubles or triples, miners can't just open more silver mines. Production depends on whether it's profitable to mine copper, zinc, lead. If those metals don't justify the operation, the mine doesn't open, and the silver that would have come as a byproduct simply doesn't get produced. This is the fundamental difference from the Hunt brothers in 1980. They tried to corner the market when it was in surplus, there was plenty of metal. Their strategy depended on buying so much that they artificially controlled the price. When the exchanges changed, the rules and margins skyrocketed, they had to sell, and everything collapsed. Silver went from almost $50 to $10 in weeks. It was a speculative house of cards built on debt. What's happening today looks nothing like that. There's no group of speculators trying to corner the market. There's a real structural deficit that's been draining inventories for 5 years. There's industrial demand that can't be reduced without shutting down factories and canceling the energy transition. There are export restrictions in China. There are inventories running out month after month. The hunts failed because they were fighting against a market with excess supply. Those accumulating physical silver today are aligned with the reality of a market in chronic shortage. It's not the same, not even close. All right, what do we do with all this? Because information without action is just entertainment, and you're not here to be entertained. You're here because you want to know what to watch and how to think about what's coming. First indicator I'm watching, the EFP spread. Exchange for physical. It's the difference between the futures price and the real metal price. Normally it's cents. When it widens to dollars, it means paper is disconnecting from physical. If you see the EFP explode, the market is saying it would rather pay a huge premium for real metal than trust promises. That's the moment you know something's breaking. Second, inventory movements on the COMEX. If you see metal moving from registered to eligible, the big players are pulling their silver out of the deliverable category. They're saying, this is mine and I'm not selling. They're anticipating they'll need that metal or that its price will go much higher. It's like watching the house put away their chips while telling you to keep playing. Third, margin hikes. The exchanges raise margins when there's volatility or when they smell a squeeze. Higher margins mean more cash to maintain the same position. It's their tool to shake out small speculators and relieve pressure. If you see 20 or 30% increases in a day, something has the people running the casino nervous. Fourth, the Shanghai premium. As long as it's above 10%, the message is that there are two markets and physical is in charge. The day it compresses, either supply improved or China cooled off. As long as it's high, the divergence continues. As for personal strategy, and this is not financial advice, it's what I do, my position favors physical metal over paper. ETFs like SLV have JP Morgan as custodian. Yes, the same JP Morgan we've been talking about this whole video. The same one that manipulated the market. The same one now hoarding physical. That bank is the custodian of the ETF that supposedly represents your silver. If you don't see the conflict of interest there, I don't know what to tell you. Physical metal eliminates the risk of someone telling you, sorry, there's no silver, here's some cash. Coins, bars, whatever you can store, that's actually yours. I'm going to close with this because I think it's important to be clear. What we're seeing is not a speculative rally. It's not a bubble fueled by internet influencers. It's not Wall Street Bet's Precious Metals edition. It's the inevitable result of 40 years of a system that sold more metal than existed. For decades, banks created contracts upon contracts, derivatives upon derivatives, promises upon promises. It worked as long as nobody looked too closely. It worked as long as everyone accepted the number on screen as if it were a reality. But now there are people asking for metal. Now there are factories that need silver for solar panels and won't accept a PDF as a substitute. Now there are investors in Asia waiting 2 hours in line to buy a coin. The system doesn't have enough metal to fulfill all the promises it made. And JP Morgan knows it. That's why they switched sides. That's why they're accumulating 750 million ounces of physical metal while the rest of the world keeps watching the ticker. The accumulated deficit exceeds 820 million ounces. COMEX inventories have less than 30% available for delivery. China authorizes only 44 companies to export. Industrial demand consumes nearly 60% and keeps growing. There's not enough silver for the future the world has planned. Something has to give. Either the price goes up until it hurts, or the energy transition gets canceled. Pick one. We've been saying this for years. They called us crazy. Today, the bank that manipulated this market the most is betting everything that we were right. If that doesn't tell you what you need to know, nothing will. If you think like me, if you see what's happening, leave a comment. Share this with someone who still believes the price on their screen is real. There are more of us than they think, and when this thing blows, I want you on the right side of history. See you in the next analysis.